Welcome to the deep dive. Today, we're really zeroing in on something vital.
Absolutely. If you're involved in trading or even just curious about investment strategies, this is key.
We're talking about the risk-reward ratio.
Yes, and, you know, understanding this properly, it's often the difference between long-term success and, well, failure. It's your main shield against really bad losses.
Exactly. People often get caught up in win rates, right? How often they're...
They do, but that's only half the picture, maybe even less.
So today, we'll unpack what this ratio actually is, how it works, and why it matters so much, probably more than just winning streaks.
And we're drawing insights from Faida Ventures Ltd for this. They build automated trading systems, and risk management is pretty central to their approach.
Right, they focus on that risk-conscious foundation.
Precisely. The idea is protect your capital first. Consistent profits tend to grow from that solid base. The risk-reward ratio is, well, core to that.
Okay, so let's get into the nuts and bolts. What exactly is this risk-reward ratio?
Simply put, it's just comparing the money you might lose on a trade versus the money you hope to gain.
A direct comparison.
Yeah, potential risk versus potential reward.
Okay, could you maybe give us an example, make it a bit more concrete?
Sure. Let's say you're looking at a trade. You decide, okay, if this goes against me, I'm out if I lose $100. That's your stop loss.
Your planned exit point for a loss.
Exactly.
Yeah.
And then you say, but if it goes my way, I think I can make $300. That's your take profit level.
Got it.
So you're risking $100 for a potential gain of $300. That gives you a risk-reward ratio of 1 to 3.
1 to 3. So for every dollar risked, the aim is $3 back.
Precisely.
And this isn't really about trying to win every single trade, is it? Because that just sounds unrealistic.
Oh, absolutely not. Winning every trade is impossible. The beauty of a good risk-reward ratio is that you don't need to win most of the time to be profitable.
How does that work?
Well, imagine your average loss is, say, $50, but your average win is $150.
Okay, so a 1.3 average outcome.
Right. Now, even if you only win 40% of your trades, meaning you lose 60%, you're likely still making money overall.
That really flips the usual thinking, doesn't it? We hear so much about needing to be right.
It does. It shifts the focus.
So why is this concept so, well, fundamental for good trading?
Well, there are a few big reasons. First, it forces discipline. Before you even click buy or sell, you have to think about the potential loss versus the potential gain.
So it stops you from just jumping in based on a hunch.
Exactly. It encourages objective thinking, helps curb those emotional decisions.
Like holding on to a loser for way too long, hoping it turns around.
That's a classic one. Or maybe cutting a winner short because you're scared to lose the profit you've made so far.
Ah, yes. Okay, so discipline is number one. What else?
Managing losses effectively. Look, losses are guaranteed in trading. No one avoids them.
Part of the game.
Totally. But a good RR strategy ensures your losses are contained, right? They don't wipe out 5 or 6 wins in one go. You keep them manageable.
That makes sense. Protecting your capital. Was there a third point?
Yes, it kind of shifts your focus from just the win percentage to finding high probability setups that also have that favorable risk-reward profile. It's about consistency in making good bets, not just being right often.
Consistency in the quality of the trade setup, not just the outcome.
You got it. It's about executing a strategy where the odds over time are in your favor because your wins are bigger than your losses.
Okay, I think we've got a good handle on the what and the why. Now, how do these automated systems, like the expert advisors, the EAs that Faida Ventures builds, how do they actually use this logic?
Well, Faida Ventures actually designs their EAs with these RR rules built right in. It's part of the core programming.
So it's not an afterthought?
Not at all. The system might be programmed, for instance, to only even consider a trade if the potential take profit is, say, at least 2 or 3 times bigger than the potential stop loss.
So if the setup doesn't offer that minimum ratio, the EA just ignores it?
Correct. It won't take the trade. It's a hard filter.
Interesting. And is it always fixed ratios, or can it adapt? Markets change, right?
Good question. They often incorporate adaptive logic too. For example, if the market suddenly becomes very volatile, the system might automatically widen both the stop loss and the take profit levels.
Ah, so it adjusts for bigger price swings.
Exactly. It maintains the proportional risk-reward ratio, but gives the trade more room to breathe in choppy conditions.
That sounds pretty sophisticated. And I think the source material mentioned other safeguards, something about overall equity.
Yes, some systems, like their Faida Profit Plus, have mechanisms that watch the overall account balance. If the account hits a specific profit target for the day or week, for example,
Yeah.
it might automatically close all open positions.
Oh, wow. So locking in the gains.
Precisely. It's another layer of risk management protecting profits already made, like banking the win.
Okay, mission accomplished. Shut it down for the day. I can see the appeal. Let's make this even clearer with that example you mentioned from the source.
Okay, sure. Imagine a strategy, and let's keep it simple. Say it has a 50% win rate. A coin flip, basically.
Okay. 5 wins, 5 losses out of 10 trades.
Right. Now, let's say each win makes you $200, and each loss costs you $100.
So a 1.2 risk reward on each trade, risking 100 to make 200.
Exactly. So over those 10 trades, 5 wins at $200 each. That's $1,000 in profit.
Uh-huh.
And 5 losses at $100 each. That's $500 in losses.
So a $1,000 gain minus $500 loss leaves a $500 net profit.
There you go. Even winning owner half the time, the strategy is profitable because the wins are twice as big as the losses.
That really drives the point home. It's not just about being right. It's about how much you make when you're right versus how much you lose when you're wrong.
That's the essence of it.
So for listeners who are maybe trading manually, what are the practical steps? How can they apply this thinking?
Right. Well, step 1, absolutely crucial. Before you place any trade, know the maximum amount you're willing to lose on that single trade.
Define your risk up front.
Yes. And it has to be an amount you're genuinely okay with losing, something that won't mess with your head or your overall finances.
No wishful thinking allowed.
Definitely not.
Uh,
Second, always set your stop loss and take profit levels when you enter the trade. Plan your exits.
and stick to them. No moving the stop loss further away if the trade goes against you.
Ideally, yes. Sticking to the plan is key. Avoid making decisions based on fear or greed once the trade is live.
Okay. And what about the ratio itself? Is there a general target people should aim for?
It depends on the strategy, of course, but aiming for at least a 1.2 risk-reward ratio is often a good starting point for many situations.
Risking $1 to potentially make 2.
Right. It gives you that mathematical edge, that buffer.
Makes sense. Anything else to keep in mind?
Yeah, track your performance, but don't just track your win rate. Track your average win size versus your average loss size. Calculate your actual risk-reward ratio achieved over time.
So you know if your strategy is actually delivering that positive RR.
Exactly. And a final warning, maybe. Be really wary of strategies that promise super high win rates, like 90% or something.
Why is that? Sounds good on the surface.
Often, those strategies achieve high win rates by taking tiny profits very quickly, but they might expose you to rare but very large losses. One bad trade can wipe out weeks or months of those tiny gains.
Ah, so the risk reward is terrible, even if you win often.
Potentially, yes. You need to look at both sides.
So it seems like getting this risk reward discipline right is really what separates strategic trading from just gambling.
I think that's a fair way to put it.
Yeah.
It's about calculated risk, measured decisions, planned exits. It's the foundation for trying to build wealth consistently over the long haul
Yeah.
rather than just chasing quick thrills.
It requires patience and planning.
Absolutely.
So maybe something for you, the listener, to think about. When you look at an opportunity, are you truly weighing the potential gain against the real potential loss? Or is the focus just on the excitement of winning? Finding that balance, well, that might be the most important trade you ever make.
Well said.
And remember, these insights today were informed by the work of Faida Ventures Ltd., who emphasized this kind of risk-managed consistency in their automated systems.
And just a standard reminder, of course, this discussion is for educational purposes. Trading involves risk.
Always. For specific financial advice tailored to your situation, please consult with a licensed financial advisor.
Definitely. But understanding this risk-reward principle,
Yeah.
it's a vital piece of the puzzle for anyone navigating the markets.